Hello Mountaineers, I'm Jordan from Mountway. Welcome to part 2 of this video series, 2 out of 2, regarding why your loan application may have been rejected. In the prior video, we looked at some of the regulation in Australia and why these rules exist in the first place. We also looked at some of the reasons possibly for your loan application to run into trouble and what you can do about them. They included having a high loan to value ratio or a low deposit, the type of income that you're earning, and some expenditure habits that may affect your application. In this video, we're going to be looking at credit scores. We're also going to be looking at the property type, any life changes that you might be going through or in future might be going through, credit card limits, personal loan, car loans, how they affect your application, and then how silly things like certain transactions that come up in your statement history may also affect your application. So without any further ado, let's get straight into it. Okay, next reason. So credit scores, they are important. Not every bank uses them, but major banks who are going to give you the best pricing, they definitely do use them. And they want strong credit scores. Okay, so credit scores are affected by a range of things. I've actually written a blog about this, about what affects your credit scores, how long it takes to repair, and what things you can do to repair it faster. Here's a link to the blog article. I encourage you to click on it. It's a whole new area, we could do a video on that on itself. Okay, let's look at the next reason. Now this doesn't affect everybody, but it definitely affects some of the clients we deal with being in the northwest of Australia. The property type. Okay, now generally, if you're buying a house, residentially zoned, and it's in a metro location, no problems whatsoever. But some restrictions do apply based on various aspects of the property you're looking for. Big one is zoning, and I see a lot of people trying to buy rural blocks for their retirement or for their getaway place, which is really, really great. But sometimes these are zoned rural. Now what that means is you can use that land to make money off via farming activities, running cattle, running sheep, growing crops. Now that's a very different thing because the property becomes income generating. A residential lifestyle or rural residential is the right zoning. The key there is residential. Now this goes down to how deep these markets are, how many buyers they might have, and therefore the safety of taking that security. Right, so that's one of the big ones that we come into a lot. Location, I mentioned location. So as soon as you get out of the cities by a long way, particularly in very remote areas, Karratha, for example, is still considered remote, but it's also considered cyclical due to the mining activity here. There are restrictions, very much so, based on lenders. Smaller lenders do not even participate here. Larger lenders will do so, but at reduced loan to value ratio thresholds. So there's those restrictions. Property type and size, now different from zoning. This is about whether you're buying an apartment in a high-rise building, for example, or a very small studio apartment below 50 square meters, right? Now these are perfectly fine places to live, and especially if that's how you like to do, single person, you haven't got many things, fine. But the reason why banks don't like these sometimes is in a high-rise building, you've got many of the same apartment. So again, there can be problems trying to sell that property if you needed to at a pinch. Likewise, small studio apartments are considered a little bit niche. And so there are problems borrowing money to buy that type of apartment. There's a couple of other ones that are in the mix too, but generally, this is only a problem if you're not looking at your stock standard house in a suburban area. Okay, let's look at another one. Major life changes. Now we do need to consider these in any loan application. Some of the frequent ones for young people is that they're expecting a baby and a parent is going to come out of the workforce. It isn't a showstopper, but we need to then look at, will this loan still be repaid when you take one income out of the mix? But that's not the only situation that occurs. Some of the ones that are very frequent that we see here is relocation. So we're in a regional area and people come here for work and they will eventually at some point move away. Relocation is tough because what we're talking about here is usually a new job or some kind of changed job circumstances. You may even have a job secured, but when you take that job, move house, take that new job, you'll be on probation, right? So your employment isn't considered secure by the lender. So relocation and new jobs are actually one of those life events that can make it very tricky to get your loan. Another one that's frequent I see is moving from employment to self-employment. And that is quite tricky because of the delay in the information that you can present to the bank that shows that you're earning enough money to service that loan. When you're self-employed, you have to work through that period and then do your tax returns and whatnot, and then actually show that information reflecting that period. So it takes a while if that is the change. And the other one is retirement. There's a few others, but retirement's a big one, right? You might be thinking, well, I'm not retiring soon, but if you're taking a 30-year loan, you only need to be 35 before retirement becomes a matter in that loan, a matter to consider. Again, it's not a showstopper, but we need to think about if there is a balance on that loan left when you plan to retire, how is that balance going to be paid? Will you take a pension? Will you pay it out in full? Will you sell other investments? Or will you continue working until you're 75? These are all relevant, not showstoppers, but they can become problems for a loan application. Okay, we're nearly there. We've got a couple of final ones. And I mention these because, people can have a bit of fun with their finances when they're young, I get it. But these things do have some repercussions. And when you'll start to think about getting a loan application together, it's best to sort of be prepared. If you go into a loan application having not thought about these things, they can really bite you in the ass. So, credit card limits, particularly cycling, right? Who doesn't mind doing a balance transfer where they don't have to pay the balance and they just roll it into another card, into another card, into another card. They might even pick up some points along the way. It's a great strategy for points. There's whole influencers out there doing this sort of thing. But what they're doing is smashing their credit rating, right? Too many credit card applications over short periods of time is one way to get your score down. The other thing though is that these limits, credit cards, personal loans and car loans, those limits have a greater impact on your servicing result or your debt capacity, the maximum amount you can borrow, than any other type of debt, be it HECS, another home loan, a family loan, whatever it is. They have a big impact. So when you say, I've got a $5,000 credit card and I don't use it, unfortunately, that doesn't matter. We go off the $5,000 limit. And so if you say, well, I've got a $25,000 credit card just so that I can go on holidays every now and then and I get massive points, well, that's really hurting your debt capacity. Now, this other one is a little bit tongue in cheek, but seriously, it happens. Okay, so some mate of yours owes you some money. You give them your credit card, you give them your account details, and they send it back to you with the description drugs or sex toys or something ridiculous like that, right? Now, believe it or not, lenders see it. In fact, expenses are more and more being assessed by software, which will pick this stuff up. And it's not just that. They pick up Sportsbet, they pick up casinos, they pick up bottlers, and it sounds judgmental. It is judgmental, but it is being done, unfortunately. So there's various degrees of scrutiny and forensicness that lenders can go into with your expenses, but some of the best and most conservative lenders in the country will get that forensic and they will ask questions about what does this mean, how often do you gamble, and sorry, by the way, if there's something that seems really nefarious, even if it's explainable, they're quite bedded down by regulation that they might just step away altogether and decline to do the loan based on that one thing, too high risk for them. So yeah, just be careful and tell your mates just to cool it with silly stuff. Okay, so let's wrap all this up, right? We'll go back to the regulation, right? Regulation is set by APRA. APRA sets a set of guideline rules and they more or less filter down in most ways into the policies that banks implement. And APRA is a government body that's conservative and has this kind of outdated view of society. And yes, it slowly updates and they occasionally update their guidelines, but still, by and large, the concept of a safe and worthwhile borrower is still someone who is financially stable, financially organised, with good income and good saving capability. Right? So these things look like people who kind of like plan their finances and people who don't just sort of like rush into things. So some preparation and some, I suppose, grooming is needed if that does not sound like you, right? So that's why it's always helpful to come in and have a chat, and we can look at your circumstances. And if something doesn't quite look good, it is usually just a matter of sort of just changing some behaviours, even for 3 to 6 months. Now, I used to budget very, very hard, but budgeting is boring. You know, budgeting is you know, it sounds like something your parents would say, and it is, right? But usually it's something which is very worthwhile as a skill to learn for a brief period. It's like getting fit. You can do that, you can learn that skill, you can get fit, you can get up to a level, and then you can kind of relax the rules a bit to suit you. But it definitely helps as a discipline over a short period of time. It'll help you get fit in the case of fitness. It'll help you get that loan in the case of your finances. So give it a shot. All right, guys, that's nearly it for me. What to do from here? Look, like and share if you think someone that you know will find this useful, or if you find it useful. Follow along. We have plenty of hopefully helpful content like this, and check out our blog. More and more stories are in there helping you guys get a better understanding of your finances, a better understanding of the loan market, and better results for your own financial, you know, progress and goals. So jump on board, and hopefully we see more of you.